Hey, good morning, everybody. It's another Saturday. Week went by pretty fast. So we're back talking again. Hope everybody had a good week. Get this thing all fired up for you. Okay. So as you may notice, since last week, got my hair cut. Went a little rogue. Went underground. Got my hair cut. Found a barber. So I'm an outlaw of justice right now because I got my hair cut. But I just had to do it. I couldn't take it anymore. I think it's a military. I mean, as soon as his hair starts getting a little long, I feel kind of like a hippie. So I just had to get my hair cut. So I feel a lot better just based on that. Let me get my screen going here. We'll jump into the presentation. Okay. So today we'll hit a few hodgepodge items. I'm going to jump around a bit. To this week, I'm going to talk a little bit about a lot of the questions I got from all of you from the past couple presentations. The other thing that I got a lot of questions on this week was oil, as you could probably imagine. You know, when it gets down to negative $30 a barrel, people are wondering what's going on. So I got a lot of questions on that. Next week, I'm trying to do a little bit of a broader sort of okay, let's think long term here. Probably the next, 2 to 5 years. What are we looking at? And I kind of called it the 4 horsemen of the apocalypse. So a real nice little title there to try to draw you back in for next week. But we'll hit a few different topics today. Talk a little bit about some general investment themes, look at oil, look at the government bailouts, stuff like that. Just some questions I've gotten on those things. So, where are we economically? Where do we go from here? And a lot of people, I haven't created this, but a lot of people use this model. One of the most famous people is Ray Dalio. You might have seen Ray's name out in the media. He's a hedge fund manager, written a couple books recently that have done really well, but he's got some really good information out there. In fact, I was just reading a new article that he put out this week talking about money and credit, which is sort of a little bit along the lines of what I talked about last time with the Federal Reserve. But his thing is, if you don't understand money and credit, if you don't understand those two concepts and the cycles, you can't understand where we're at or where we're going. Well, what he does, and a lot of hedge fund managers and money managers do, is they kind of try to figure out where are we at, where's the market at as far as cycles, and they break it down into 4 quads, and I try to do this as well. So quad 1 at the top left, that's sort of a Goldilocks scenario. So what that means is we have the economy growing. So you have positive economic growth, GDP is going up, but the inflation is holding steady or even slowing a little bit. So, I mean, that's kind of the Goldilocks scenario, right? Not too hot, not too cold. So you have a growing economy, but you have lower inflation. So that's always something that people are, kind of looking for. And what's the Fed's policy in here? Fed usually is pretty much let it go. Let's let it ride. So you don't have to worry too much about any kind of crazy Federal Reserve moves. Then you bump over to the second quad, and that's the top right, and you have reflation. So reflation is usually kind of what you see maybe coming out of a recession. It's a period where you do have the GDP growing, so you have the economy is growing, but you also have inflation accelerating as well. So you have a Federal Reserve that probably is going to have what they call hawkish policy. They're going to be raising rates or trying to pull some money out of the economy to keep inflation in check. But they try to do it without affecting the growth. Then you go to quad 3, which is the bottom right. Now we're getting into some lack of growth, some slower periods. So you have, it's either stagnation or stagflation. So you have slowing economic growth. So the GDP is slowing, but you still have inflation. So this is not a really good area to be. You don't want to be in this area. So inflation's going up, prices are going up, but growth is slowing. And then finally, in the fourth quad, in the bottom left, you have deflation. And that's also just an area you don't want to be. So you have slowing growth. So the GDP is slowing down, but you also have inflation decelerating. So basically, things are shutting down. And what you want to try to do at all times is get an idea of where are we at right now? Where's the economy at? Because it drives where you can invest. Clearly, I think right now we're down in quad 4, kind of the death knell for the economy. We've got growth slowing down. We also have inflation slowing down, as you can see by the price of oil recently. So we're in a pretty tough position, but what you have is the Federal Reserve is going to try to do everything they can to try to get some growth and some inflation going. They don't like to be in quad 4, so they do whatever they can to get out of it. But I think we're probably really deep in that quad 4 right now. That's where we're kind of looking, and you have to assume it. So even with, the market has bounced up a nice chunk here, but you have to say, have we changed our position in this 4 quad model? And as you can see, I've got the axis here. So when you've got the vertical axis, the y-axis, that is indicative of economic growth. So are we shrinking or are we growing? And then across the horizontal or x-axis, we have inflation. So do we have inflation going up or do we have it shrinking? So that then takes us to, what do you invest in during these 4 periods, these 4 quadrants? So if you look to the far right, that's where we're at right now, quad 4, it's deflation. So if you're looking at stocks, the sectors that typically do better in these periods are consumer staples. So that's going to be your, right now, toilet paper, right? Kimberly-Clark, Procter & Gamble. Those stocks have done pretty well because people are buying toilet paper. Utilities, even in a deflationary period, people are going to turn on the lights. Real estates typically do pretty well in deflation. If you have consistent rents coming in, but other prices are going down, that's kind of an optimal period, place to be for an investor, although REITs have just gotten smashed here this past month and a half. And then healthcare. Healthcare is always, again, another thing that people are using quite a bit. You would think with the coronavirus that there'd be a lot of people using healthcare right now, but it's actually quite hospital that are furloughing employees and they're actually in a critical situation financially. Some of the areas you don't want to be right now are financials. So bank stocks are just not a place to be when you have deflation. And that's pretty much been proven so far this year. You also don't want the high flyers like tech. Energy. Look at what's happening to oil. So obviously energy is not a place to be. And in industrials, you're not, during a typical recessionary environment, deflationary environment, you're going to have less production. Some other sectors you might want to look at for stocks, you want high dividend yields, high quality, defensive kind of companies. You don't want momentum companies, high beta. What that means is much more volatile stocks. You want to avoid the high volatility stocks. And then you want to avoid growth and small company stocks. Those are some of the things. But you also look at some of the bonds. You want to be in municipal bonds. You want to be in long duration treasuries and intermediate treasuries. So you're talking anywhere between 5-year treasury out to 30 years or more. So those tend to do very well. And then as you can imagine, the preferreds, the convertibles, leverage loans, junk bonds, they don't do quite as well in this kind of environment. But you can kind of see, if you look at this chart here, all around, what is going to usually work better in different environments. And typically what you find is we go from quad 4 and you're going to bounce back up into quad 3. So you start to see still some low growth, but because the Federal Reserve becomes so accommodative that you start to get some inflation. And then you want to kind of switch things around a little bit. You still have some of the sectors like utilities and REITs, they do pretty well, but tech and energy also tend to rebound quite a bit. So, with the price of oil dropping the way it has, everybody, and we'll talk about this in a second, but everyone wants to kind of jump in, catch that falling knife. But it is one of the sectors that you can kind of tell we're getting through this when it starts to pick back up. So this just gives, this is like a framework that I kind of use. I don't only use these vehicles, obviously, in different situations. But if you've been a asset management client of mine, you might remember the past year and a half, we've had money in utilities and consumer staples because I felt like we were already getting at that end of stage bull market and the economy was starting to slow. The coronavirus took it down to, way beyond a crawl. But we were already slowing before that hit. So, the utilities and consumer staples have done pretty well the past year and a half or so. But this kind of guides some areas I look to add a little extra value and you can get a little bit extra return as an investor with that. Now, the only thing that's kind of been interesting here with what's going on the past couple of years, but especially right now, is so much of the market has been led by 5 companies. And even now, you remember the last slide, I said tech usually doesn't do well in these environments. And for the most part, tech hasn't, except for the stocks. Microsoft, Apple, Amazon, Google, and Facebook have all weathered this extremely well. Microsoft and Amazon are actually doing quite well this year. A lot of people just assume it's Amazon because we're not going anywhere, so we're getting everything shipped at home, which is kind of interesting because Amazon doesn't really make much money on the retail side. What they're mostly known for, they don't make any money. Most of their profits and revenues, not revenues, but most of the profits come from their AWS, their web services. So they basically, a lot of companies will host their platforms, their websites on Amazon's platform. They develop that. So it's interesting. That's where they make most of their money. And that's probably an area that's going to get hit a little bit as companies go out of business or they slow down what they're doing online, cut back. But Amazon's done really well. Microsoft, Apple is one that surprises me because I just don't see how they don't escape this. I really, unless I'm judging things wrong, I can't see people spending $1,000 on an iPhone in this environment. I mean, maybe if it goes kaput or something, but even then, I bet the secondary market, people won't go for the new iPhone. They'll go back to a Model 8 or 7 or 6 or something. Facebook too. That's another company. It's ad driven for the most part. So, some companies maybe they're doing more marketing, but I don't think so. But anyway, this is kind of a dangerous position to have 5 stocks make up such a huge part of the S&P 500. It's over 20% is what they're making up as far as the composite. And just to give you another view of how that looks, these are the 500 companies in the S&P 500 and the percentage of weight. That's pretty massive. You can see it's not a healthy thing to have that few companies leading the way in the S&P 500. So if it wasn't for those 5 companies right now, the S&P would be down even more. Those have kind of held the market up, but that's not a healthy market by any stretch of the imagination. And usually those things kind of self-correct. When you look at it, back in 2000, we had 5 stocks leading. It was Microsoft, GE, Cisco, Intel, Walmart. And 2000 was the peak of the tech bubble. By the time we got through that, you can see, the top 5 stocks really, anything above 15% is kind of a scary place to be. And, right now we're over 21. So that's an interesting thing with the investment environment too. So you could argue, hey, let's go in those 5 stocks and ride it out because they've done well. But it's also something that, I don't know, just from a risk standpoint, is it really worth it? A lot of questions coming in about, economic growth and where does this kind of factor in? And I tried a couple of weeks ago, I just talked about, really how this is going to be way deeper as far as an economic contraction than anything we've ever seen. There probably isn't anybody alive that or at least watching this, that was around for the Great Depression. And that's probably the last time we've seen a greater than 20% decline in the gross domestic product or the economy. Even back in 2008, where you saw the market drop 56%, that felt pretty brutal. But the peak to trough decline in real GDP was just over 5%. At the most, it did hit about down 7.5%. But it wasn't really all that bad. Even in the tech bubble, that was more of a kind of a situation where you had a misallocation of capital in the tech field. But that recession was less than 1% peak to trough. So we haven't really experienced any kind of double-digit decline for a long, long time. And you can see from this chart, the Great Depression had basically two periods where we saw close to 20% declines in GDP. And there's just no way that this thing hasn't severed us to the point where we're going to see at least a 20% decline in gross domestic product from a year to year. The big question is going to be, when does it come back? How quickly is this thing going to bounce up? And that's a tough question to answer. So then jumping into the big question for the week, which a lot of people ask me about, is oil. Like, what is going on with oil? This is a chart showing you going back to about 2002, what the price of oil has done. And you can kind of remember before the 2008 crash, oil got over 140 a barrel. Can you remember that? That was just amazing. I just, when you think about, we got negative per barrel cost right now, and it was over 140. But you can see oil's always been kind of a volatile asset class. And, right now it's just fallen right out of bed. It's just been crazy what the prices of oil have done. And it just gives you a little perspective of U.S. oil production in millions of barrels per day. So, back when Dallas was on TV in the 80s, you can see we were about 9 million barrels per day. That was kind of the heyday. The 70s and 80s were the heyday for us in America. And you can see it just continually dropped from there until the shale started taking off. And since then, we've had a good rise. But you can kind of see where we're at now. It's just really, it's unsustainable, honestly. We've got a situation now where the market has just been absolutely flooded with oil. And they think right now we're going to end up having over 1 billion barrels just in storage. So we have a lot of oil to work off before we're ever going to start to see that price make a substantial move up, because there's just so much in storage. And the problem is, so many countries depend on the price of oil. For us, it's not that important as far as the overall economy. It's not going to help if we continue to have low oil prices and they take production offline. You're going to have people lose their jobs. You're going to have companies go under, which means a lot of their debt's not going to be repaid. None of that is good. But when you look at a lot of countries, this is their only revenue source. Obviously, Saudi Arabia, it's a huge part, but I think they're loving this. The first price of oil started dropping a couple months ago when Russia and Saudi Arabia refused to bring down production. They saw this as an opportunity to kill the U.S. shale industry, and it's probably going to. So they were trying to hurt us politically. Russia figured at $15, even $20 a barrel, they could still be okay, because they would get enough revenue in to run their operations. And for Russia, they don't have a big tax base. It's almost all oil. I think what's happened here is it's starting to work against them. If oil is below 10 a barrel, they're in trouble. Even Russia is going to have a problem making their budget, and nobody's going to lend to the Russians right now. Nobody's going to lend to them. They don't have much debt as a nation, and because nobody will lend to them, and they're not going to be able to do it if oil stays this low. There's just no way that it's going to cause a lot of issues politically going down the road, because now they're going to be in kind of a tough situation. Saudi Arabia will be fine. They're even at $10 a barrel, they're still making some money. They have so much money, so much oil there, but it is their biggest revenue stream. But there's a lot of other countries that are going to have some serious issues. I mean, Iran, they're heading for a serious political situation, because they're pretty much reliant on outsiders coming in and taking care of their oil for them, and that's completely stopped. So they're at a point where they don't have the internal capacity or ability to run their own oil fields. So that's an enormous revenue source for them, and that's basically gone. And they haven't been shipping much out because of what the U.S. has been doing as far as all the tariffs and blockades and all that good stuff. So they're going to be politically unstable. That's going to create instability there. Nigeria is another country. It probably doesn't have a big impact on us as far as the U.S., but it's going to become very unstable because most of its revenue is from oil. You just start to look at all these countries. Norway, it's a very wealthy country, but they make most of their money. So for their, the social state and all that stuff is basically oil revenues. And, that's going to go away. And a lot of their oil is offshore drilling, which is even harder to do and even more expensive to do. So, with oil at $10 a barrel, it's not going to be worth their while to do it. So this is going to create not just some crazy price movements, but it's going to create some political instability here too. And you don't know what the ramifications are going to be for that. It's probably going to heat things up in the Middle East. It's going to create some tension with Russia. I mean, who knows what's really going to go down. And the thing you have to remember is, while the price of oil for the May contracts went negative, it didn't mean that, oil overall was going to be negative. Okay. You got to remember how commodity markets work. They're a futures market. It's not like the stock market where you buy Disney stock and you just own that stock and it fluctuates according to how the profits of Disney fluctuate. What you're doing in commodities is you're buying contracts in the future. Okay. And I use this example that makes it easy to think about. You got the farmer, and then you've got the company that buys the farming goods and processes it, turns it into cereal or whatever, flour. So, when that farmer is going to plant his or her crops, let's say it's right now. So we've got April, and they might say, okay, well, the crop starts coming in July, goes into August, maybe to September. So, they want to make sure that they make a profit on their crop. So they look and see, well, what's somebody going to pay right now if I deliver my corn in July or August? What could I get per bushel? And that's where the futures markets come in. The futures market, commodities typically shouldn't be an investment. It's mostly a means for people who sell and buy commodities to define the price that they feel is right. And so you take that farmer, if he's looking at the July price of corn and it's really low, he's not going to make money on it. Well, then he can start to pull back a little bit on his corn crop before he plants it. And maybe he'll look at other things. All right, so soybeans, they're paying a little bit more. I'll put some of my crop towards soybeans. So again, the price of the commodities dictate the usage of the land. And usually once the farmer finds that price that they feel they can be profitable at, they buy or they sell a contract. So they'll sell a contract to deliver corn at $3 per bushel in July or August or September or whenever the crop's going to come in. Now the price might end up going up to $3.30 or $3.40, $3.50, and the farmer's like, I missed out. But if the price goes to $2.50 or $2, they sold that at $3 a bushel. They've locked in their price. So has the person who bought that contract. So the factory that's going to turn it into cornflakes or flour or whatever, they're locked into it at $3. So even if the price goes down, they kind of missed out. I use the farmer example because that's pretty easy to think about, but it's the same with oil. So when you've got these contracts for oil, you typically just have people who are producing the oil and then those who are going to accept it. So you've got Saudi Arabia, Russia, all that. And then you have Exxon, Chevron, all those other companies on the other side. And they're looking at the futures market, trying to determine how much they're going to need. And then the price is dictated by that. And it fluctuates up and down. And it rolls month to month. So the contract for the May delivery date of oil is the one that went nuts. It's the one that absolutely tanked and went negative, almost a negative $40 per barrel. But the futures were still positive. We're still looking at $10, $12 a barrel. In fact, let me show you that slide. So this was a day after the big collapse, but you can see the oil futures prices. So the May of 2020 delivery had actually, dropped to the point it was negative. It closed at a negative value. But the June delivery date was still at about $15 a barrel, or 20 when it really tanked. And then you have the July, which stayed even higher at 26. So if you look at, this was the day after the carnage, so it says last. So $1.52 is May delivery per barrel. $14.88 for June, $23.05. So it wasn't like the price of oil was going to stay at $1.52 and you go to the pump and you're going to pay 20 cents a gallon. You've got a skew up. And that's typically how the futures contract should look. Over time, you would think that the price of it should be going up. That's a normal curve when you're talking about futures. That's what they call in investments contango. So in that, what you should typically have is the current month's price is usually less than next month's and then the month after that. Usually. Doesn't always mean that way. So sometimes they become inverted so that today's price, the current contract price, is actually higher than next month's or the month after that. Now that could happen in periods where, let's go back to the farm. Once we get past September, maybe even October, the price of corn is probably going to drop because there's just not going to be a need for it. They usually buy all that and they get it all from the U.S. now, before October, but also just there's no production of it, so the price will drop. So you could see basically through the winter, you'll see an inverted curve. So you'll see the future months are less than the current price. That's called backwardation. Isn't that a cool name? So that's what they call it in investment terms. So contango, you have a normal upslope, backwardation's going the other way. So we still have a normal curve for oil futures. So future prices are still higher than the current price. So why did the current price fall so far? Well, it comes back to having just so much oil right now is being stored up. When you have that much stored up, you don't have a need. Chevron, Exxon doesn't have the need to take more on this month. So there's a normal supply and demand there. But as I mentioned before, the futures market is mostly set up for people who need the underlying commodities. But there is speculation in commodities. There's investors out there. So that's where it kind of got really messed up, is you have a lower need for oil right now. We have we're going to have 1 billion barrels just sitting in reserves. So you don't have a big need for it. So that's going to bring downward pressure on the price. But you also have a lot of investments out there. And probably the biggest one that has been out there is USO. That's an ETF that invests in oil's futures. It's probably the most liquid, but most of the oil-based ETFs use futures. So it's about 30 to 50% of the overall traffic in the commodities futures markets. So it's a pretty big part. Now, the way the USO operates is they have 100% of their investment in the next month's futures contract. So they had all their money in the May contract. And then every month they sell those positions, take the money from that, and they roll it to the June futures contracts. And then when we get through up to June, they sell that and go to July and August, and they just keep going. That's the way it functions. Now, when you have a pretty normal supply and demand where you don't have a billion barrels in storage of oil, that 30% that USO is and the other ETFs are adding to the speculation, it doesn't really move the market that much. It will a little bit. But right now, because there's such a low demand for more oil, when they started selling their futures contracts, it just dropped the price radically. I mean, people took a massive haircut in how it operates. And so USO was selling their May futures, and that's what really caused this thing just to plummet. The June futures didn't drop nearly as much. Now, USO is changing the way they operate a couple different ways. One, they're no longer going to just 1 month out because of this. They kind of learned their lesson. Their investors are taking a huge haircut because of the way it operates. So they're going to start spreading out between June, July, and August. So they'll spread the risk a little bit. But there's a lot of risk when you have something like this. In a market that's sloped with contango, if you sell these contracts in May and you get your money from that, you might not have the ability to buy as many contracts for June. So you're going to lose money when you have the market in contango. Now, the other way with backwardation, if you sell the May contracts and then you have more money to buy more contracts in June, that's where you make your money in commodities. So if you're ever going to be looking to invest in commodities, and that includes oil, the ideal situation is to have backwardation where the future months are actually a lower price than the current month. That's what you want to look for. I don't like using a lot of investments where you're using futures because it's really difficult. You can even have the price of oil going up over time and still lose money with the USO because of the way they roll the contracts. If the price of oil is going up, your current month contracts, when you sell them, won't buy as many contracts for the next month. So you start to lose money that way, even though the price of oil is going up. So there's not a really strong correlation between USO and the price of oil as much as you would think. And then when the price of oil is going down, you could still make money with USO. It's the way the futures markets work. So I kind of stay away from them. So I mentioned there's two reasons USO hasn't done well or have changed their operations. One, it's now they're going to do it over 3 months instead of just rolling to 1 month. And the second thing is they've stopped creation of this ETF. So the beautiful structure about the ETF is whenever more demand comes in for more shares, they just create them. So the New York Stock Exchange, NASDAQ, whatever, who's ever managing it just creates more shares. That's the beautiful things about the ETF. So many people look at ETFs and they want to say, okay, well, how many people are selling shares? How many are buying? That doesn't matter with an ETF. Because if there's a lot more people buying, they just create more shares. Or if there's a lot more people selling, they can sell and liquidate shares for the ETF. That's the beautiful thing about it. It's not like a stock where you want to have an equal number of buyers and sellers at all time. It doesn't matter with ETFs. So they've stopped operation of new shares for USO. So some really big developments as far as investing for energy, really. And you can kind of see that the price of the oil drives the energy earnings. Obviously, that would make sense, right? If your big product is going down in price, your profits are going to go down. But it's extremely correlated. You can kind of see. And right now, this is through April 21st. They're projecting, energy earnings per share at only $4.63 per share. So I've gotten a lot of inquiries from people. Is it time to get into oil? What should we do? Should we get in? Well, right now, probably not. Not until we get some sort of stability in oil. Now, there's going to be money to be made because oil is not going anywhere. It's just such a huge part of the economy. So as the economy gets better, we should see oil doing better. And as I mentioned early, when we go from the deflation quadrant to the stagflation, oil is one of the sectors that do pretty well. But you got to be careful here. The main reason is this is a chart for volatility of oil. So this chart goes back to 2007. And so remember, the higher the number of volatility, the more volatile it is. Pretty simple, right? That red line, the dash line, was kind of when we get into a quad 4 volatility level for oil. Last time we did that was 08, 09. And the peak then was at 88. Okay, so volatility got up to 88, which is extremely high. If you look historically, we're way below that normally. You're probably anywhere from 25 to 40 is kind of a normal volatility for oil. So right now it's at 300. Okay, you can't. There's no safety in investing when volatility is this high. That's the problem. At that point, you're just hoping you get lucky and hit the bottom, or you're just going to have to really close your eyes and ride this thing out for a while. But it's going to be extremely volatile. Now, if you're a day trader, you like volatility. That's what day traders like. This is a great opportunity if you're a day trader. But historically, day traders don't do too well. So I would highly recommend you don't do that. But it's difficult to get in when volatility is like this. So what you want to see is volatility start to pull back. I'd like to see it get below the 2008 peak of 88. Once it starts pulling back from that, and we start to see us moving from a quad 4 to quad 3, we start to see inflation pick up a little bit. That's probably the time you want to get back into oil. Now, that said, it doesn't mean that there's no ideas for oil. A couple of weeks ago, I talked about tanker stocks, and I think that this is probably still very valid, although they have jumped quite a bit. Kind of kicking myself. I didn't invest in these because I just don't feel like I can invest for clients unless I do some research and try to dig a little bit deeper. And while I was trying to find time to do some good due diligence, these things have jumped, 10 or 15%. But a couple of them that I initially liked, and now I'm thinking this is probably the place to go. DHT Holdings and Euronav, those both look pretty good. DHT, it's got almost a 6% dividend yield, and it's only trading at 15 times their current earnings. So it's not expensive either. And it does mostly just pure crude oil. You have to look at what the tankers do. That's why you can't just invest in tankers overall. I mean, a lot of them do liquefied natural gas, which hasn't taken the beating that, or it had the supply issues, the supply glut that regular crude oil has. So, liquefied natural gas tankers, they're probably still operating on a normal basis. There's nothing that, they're still fighting to get business. Whereas the pure oil tankers are, they're going to all be filled up, all of them. We have already filled up, I think 90 to 95% of our on-land storage for oil. And right now, Saudi Arabia has, I think it's 500 million barrels on these tankers coming to the U.S. So these tankers are going to get to the point where they're just going to anchor out to sea. They're going to anchor out in the port and just collect their daily fee, and they're not going to have to do anything. Their costs are going to drop. They don't have to burn the fuel because they're not shipping. They're not actually shipping it from point A to point B. They're just sitting there. They're not going to have to staff as much, so they'll probably go to skeletal crew because they just have to sit there. So it's a good opportunity to make some money in these. So DHT, Euronav, both look pretty good. 5% dividends, not too bad on the price to earnings. Another one to look at, Torm PLC, lower dividend, but it's only traded 4 times current earnings. Now this one, it's not just pure crude oil. They do a lot of jet fuel. So as you can imagine, not a lot of jet fuel being used right now. So they're going to be, I think they have 18 to 20 tankers. They're all going to be filled up. They're just going to be anchored out to sea and just collect their, get their royalty checks and just sit there. So I think those are probably 3 pretty good ideas. If you're looking at it, I'm looking to add some of those this week for clients. Another idea is pipelines. So as I mentioned, I don't like to invest in the oil, like the futures, because it's tricky. It's not, you're not getting the exact price of what oil is doing, whether it's going up or going down, because of the contango backwardation. there's a lot of things going on with futures markets that, you really can't control. There's also costs with futures. I mean, we could go way down the rabbit hole, but there's interest costs, there's all kinds of carry costs, things like that. So I try to find things that are actual oil companies if I want exposure to oil, because remember, the price of the oil companies, their earnings are very highly tied to the price of oil. So if the price of oil is going up, typically oil stocks are going to do well because their main input is going up. So I try to avoid the futures investments, USOs and the others, and try to get into actual oil companies in some way. Now, another one I've always kind of liked is the pipelines. I mean, these are boring. There's really no reason for this to be tied to the price of oil. All they do is they take oil from point A to point B. That's it. They're like a taxi more than an oil company, but they have been highly correlated to the price of oil, and they've gotten just hammered this year. Now they're going to have some issues because we're not shipping as much oil. We're not using as much, as people are sitting home, they're not driving as much. We're not transporting as many goods. So these have taken a beating, but I'm hoping that the price is kind of indicative of what future movement across the pipelines is going to be. I don't know. Can't be certain on that. But this is something where they're very boring companies, and the tax structure, most of these are master limited partnerships. And what that is, it's a tax structure. What it means is for a company to avoid taxation at the corporate level, to avoid the corporate tax, they have to distribute 90% of their profits to the shareholders. So they're high dividend normally. So you get a pretty good dividend off of these investments. One of them, an ETF, AMLP is the ticker symbol, the Airline Master Limited Partnership. It's down 44% this year, but right now it's got a 22% yield based on the dividend from the past. So if you bought it and dividends, if the payouts don't go down, you get a 22% yield. Now, remember, they're not shipping as much stuff right now. They're just not. So that 22% yield, you're not going to get that. More than likely, it's going to come down from there. So I just can't imagine a situation where they would make as much money if they're not shipping as much product. But still, you have to say, okay, we're going to be doing, you got to be shipping oil somehow, and pipelines are probably the biggest way to do it. So, it could be an area you could ease into. I don't think I'm going to do it quite yet. Another one is Kinder Morgan. That's not an MLP. It used to be, but it's not anymore. But you're looking at there, it's at a 7% dividend, trading about 25 times their earnings, and they're down about 33% this year. Now, again, the dividend could get hit. In fact, Kinder Morgan released some earnings Thursday, and they're taking a $1 billion impairment. So they're feeling it. They're feeling some pain there. So there's still a lot of unknowns here, but maybe if you want some good dividends and you want to get into oil because you think, how low can it go? We're talking $12 a barrel. It's got to go up. If you want to try to be early, you might be a little early. But these are kind of the things that I would look at, the tankers and, maybe the very passive MLP structure. So talking about the USO blowing up, another question, I've talked about, I don't really like a lot of the futures-based ETFs because they don't work always when you want them to. This is just a list of leveraged ETFs that have been blowing up. So these are not only are they using futures or options within the ETFs, but they're levering that. So they're going 2 times the movement of the underlying index or 3 times. They've got some that are shorting the markets. They have some that are long the markets. But you're starting to see with what's going on with the massive volatility out there, these things are just blowing up. So again, you could make a lot of money with a leveraged ETF if you're going 3 times what the oil markets are doing or what the stock market's doing, and it goes up. Hey, you're going to make some money. But you could also see these things blow up. So a lot of these blew up. You might have been short. Like one of them is. Where is it? The Ultra Pro 3 times short crude oil. So with crude dropping from its $40 a barrel to under 12, if you made 3 times that move, you could have made a fortune in theory. But what happened is the ETF just blew up, and you end up losing money on it. So be careful. Don't let the price decline make you more aggressive. You got to stick with kind of where you're at with the plan. A lot of questions and other questions I'm getting. You've probably seen a lot of news on it. The payroll protection program that the government, the bailout for small businesses. I mean, this has been an absolute nightmare. And, while in theory, I think it was a good idea, I'm just not real happy with all of it. The only thing I would have done if I was in charge is make sure that extend the unemployment, try to do something along those lines, try to help out the hospitals a little bit, but you got to let markets work. And because what you end up have, you get a government program and it just turns out to be just a total waste of taxpayer money. So end up 94 publicly traded companies received loans. You have, so it's meant for business with fewer than 500 employees total. Hotel and restaurants kind of got an exemption. So they got to the point where if they had less than 500 per location. So that opened it up for Potbelly Restaurant, Ruth Chris, Shake Shack. They got $10 million each in loans. Now, Shake Shack has said that they're going to give it back. I don't think they would give it back. They were trying to make it look like they're doing it for the good of the people. But the same time they got that $10 million loan, they also got, I think, another $125 million in credit. So they didn't really need it. A lot of the companies had more than $100 million of market value. So, I mean, that's clearly not a small business there. And then why did this happen? Well, it's like anything, right? You're going to do what you do as a bank to reward your biggest customers. So the banks they fought this PPP to start because the fees were too low. So, even though they got the bailout, they're getting bailed out by the Fed. They got the bailout in 2008. Now they're not trying to operate here to help small business. But what did they do? Well, they ended up only helping out some of their bigger clients. They got 5% on the loans up to $350,000. Now that's a pretty good chunk. 3% on loans of $350,000 to $2 million, and then 1% on loans from $2 million to $10 million. Now you might think, well, getting that 5% is great, but you got to remember the size of the loan. This means they get about $17,500 if they process a $350,000 loan. But if they do a $10 million loan, they get $100,000. So fewer loans to process, bigger payout. So Bank of America, they wouldn't even deal with you unless you had a loan with them. And not even a credit card, not an account, bank account, checking account. No, you had to have a loan with them. And that's, even then, it's pretty clear that they were letting their big guys get access to this. This was just a complete and utter waste. And I have a feeling even with the new additional monies that they're putting into it, we're going to probably find it's still going to be a lot of abuse in it. So I wasn't really happy with that. And that's, that is the area that people need. This is just sort of a chart showing you how long could a small business survive the shutdown. And if you look down at the chart, you're talking 55% of small businesses can't go more than 3 months. That's it. They're done after that. And I would bet most of it is closer to a month to 2 months. It's very few small businesses that can get out more than, up to 6 months. You're just not going to see that. The chart next to it is even more alarming. It's individuals. How long can individuals? What's their emergency savings? I mean, that's just crazy. When you look by age, I mean, I would expect the early to 18, 29, even 30 to 39, that number might be high, because they're starting their careers. But these numbers are high even for people up into their 60s. So that's kind of scary. Some other things that I'm going to take just a few seconds. What time is it? Sorry, I'm probably rambling here. But this is to give you an idea of the airline CEO stock compensation. So this is another way to show you how the bailouts just fail. So this is the 4 major airlines that got a ton of money. And you can see that these guys have basically pulled out about $337 million of stock. This is just the CEO. And then they get a bailout. And what I'd like to do is just take a second to show you a video. which basically perfectly encapsulates exactly what my view is on this. This was a gentleman who made a lot of money working for Facebook, but then became a money manager. Now he's pretty well known, and he had a couple interviews. I hope you can see this. A couple interviews with CNBC, but this is really good. So if you can't hear this, please let me know. Okay, can't hear it. Okay, let me stop this. Okay, sorry. I thought I could get that plugged in. I'm not sure what I can do to get it plugged in. Anyway, so essentially what he was saying was what I said a couple weeks ago. Just let them fail. Let the airlines fail. Let them go to bankruptcy, Chapter 11 or Chapter 13, because for a couple of reasons. One, it means that the people who invest in those companies, which he talked about being hedge funds, and he is a hedge fund manager. He says, let the hedge funds go down. Let them take the hit. Why should the taxpayer have to step in when there's perfectly good Chapter 11, Chapter 13 in place that will allow for the shareholders and the bondholders to take a haircut, but it keeps the airlines operating, so you don't end up with the job losses. Everybody's still got a job, but the loss should go to where it should. It shouldn't go to the taxpayer. It should go to the investors. That's a risk you take when you invest. And so this caught a lot of people by surprise. CNBC, which you think they try to make it like they're the bastion of capitalism, but the reality is they love these bailouts, and there's really no reason for that to happen. So now the oil companies are going to be stepping up, trying to get some money, and there's no reason we should do that. The chart I showed you, you can see we're producing way too much oil. We went too far. We've leveraged too much. Got to let the markets work. And at the end of the day, you're much better off doing that. Way better off. So let the market clear, let it function. We get through the billion of oil barrels that are just sitting there. We get through that, and then production can come back. You're healthier. So I'll try to send this out. I know I've got a few people saying, can you send me a link? It's really good. He does a great job of it, even if it's just to kind of slam it in the face of people who are arguing for bailouts. But that video goes into his first video, and then they had him back again. They tried to, it's funny because they brought him back to try to slam on him. They refined their arguments a little bit, and he just ripped it apart again. So it's good TV if you, like me, if you're a financial nerd or something like that. But it was just good to see somebody in the financial industry saying this is just ridiculous. Let's let the markets fail. Let's let them correct. We'll get through it. I mean, all the airlines went through bankruptcy before, so this isn't something they haven't done before. Okay, so now I'm just going to look at some of the questions. That's a good question. So one of the questions is what opportunities in the meat storage going forward? So if you have been following any of the news, you've got a lot of meat processing plants closing down. Purdue's closed a couple, so chicken, pork is really getting hit hard. So we're going to start to see the price of meat go way up. That's a good question. Meat. So it could be and again, I'm just freestyling here, but it could be time to look at some of the companies that produce a lot of meat, because their prices are going to go up. Again, their primary input, the price is going to go up. There's still going to be an enormous demand. It's not like Americans aren't going to eat meat. So that's one thing. You could take an alternative approach and look at some of these Beyond Meat, which isn't meat. It's the processed peas basically. It's the vegetable burgers that's supposed to taste like burgers. I mean, that could be a sort of a contrarian play. That could be something you could do. Let's see, another question here. What's a reasonable PE going forward? I assume that's probably for oil. So for oil, a reasonable PE, you probably want it sub 10 would be a time to think about buying. If you're 10 times current earnings, that would be a good time to look at it. That might be worth taking some volatility if you see that. I mean, 15's kind of a normal, but when you have this much volatility, you want to get paid a little extra for taking that extra risk. So maybe a 10, something along those lines. Is Boeing a good investment now? Oh, I don't know. I mean, they are going to get a bailout, but I don't know with their issues with the aircraft. There still doesn't seem to be anywhere near it. I know they are going to be starting their earnings are this week, I think. So you'll get some idea. I do expect them to start shuttering plants and employees. I think that's going to happen this week. Now the market might actually like that because you're cutting costs while revenues have been hurting. The other thing is, how quickly are we going to start flying again? How quickly are airlines going to be ordering planes? That's probably the other big one. So is it a good investment long-term? Probably, but I don't know. I don't think you're going to see a big uptick from here, even with the bailout. Any other questions? Okay. Can I research the meat issue? Yeah, I'll try to look at that. That was a good question. It's going to be interesting to see as that starts to get into our food delivery. We're seeing it with meat. Are we going to see it with other areas as well? And it all comes back to how quickly are we going to get back to normal? That's the biggest thing. So again, next week, what I'm going to talk about, I call it the 4 horsemen of the apocalypse. We'll look at some long-term trends that we have going against us. And then what do I kind of see here for the next year or 2, 3 years? Okay. All right. So if you have any other questions, please, shoot them to me. You can always send them via email. I'll try to reply back to you. Hopefully we'll see you next week. And please bring the questions because that's what I based all this on today. That's what I love. So we'll talk to everybody later. Thanks for checking in.